The question is, what will the market take from this? And we've got Ajay Srivastava joining us, Managing Director of Dimensions Consulting. Ajay, you heard what my colleague Shrimi pointed out, what the theme of Budget 2026 could well be. But what do you make of that, one? And two, was there anything missing from what she said that you would like to see in the document?
I think it's an excellent thing. If they're doing it, it's a great thing because our regulatory scenario has been pretty stringent, and if they relax it, it makes a lot of difference for the companies to work. But I think the main issue on the table at this point of time is the efficiency of government spending, including the capex. And I'm re-emphasizing that when we talk of FI coming in, FDI coming in, let's understand that how do the investment come in? Because environmentally, we have a problem in this country, right? At the end of the day, we all know about the AQI, the pollution, the problem, the water problem now. Now, how do you convince foreigners to come and invest and come and live in this country if this is what we present? I think we are looking forward to see, is there a big agenda of making government capex, which is huge sums of money being spent, more efficient, more accountable, and in line with making the living standard of this country going up. Rest is always fine. Economics and all will work if you're healthy. Otherwise, there is no point of having money in the bank if you can't breathe clean air. And I am a citizen, so I have no choice but to do it. But you have a discretion of FDI investment to come or not to come. And unfortunately now, this has become a big criterion as we talk to all the companies overseas to say, listen, how do we send people into this country where you've got a health hazard sitting out there? So I think we are looking at a lot more on efficiency of government spending and environmental impact and this whole thing about the city's infrastructure going up more than anything else, because everything else is domestic. You got to get capital around the world and get people to stop taking money out of this country. That is the real dilemma and the challenge for this country and the markets in this year.
Ajay, very good morning. Tamanna here.
Good morning, Tamanna.
In terms of how crucial the budget is going to be, and reading between the lines when they're talking about the theme of deregulation, do you think that's something in store for capital markets as well? Or would you hope?
I think let's look at deregulation in two aspects. One is respect to what happens with respect to the general law and order and the commercial guidelines and so on. And second is respect to the PSUs, which is the largest thing on the table, because that's where the big value sits the government. And the third thing is what the deregulation is going to do to our spending, because interest cost today is the biggest component of our budgets at the end of the day, biggest component of what's holding back growth. You've seen the yields, and interest rate reduction is all a cosmetic. You've seen the yields going up and at 6.6 in the yield and 7.5 for state government loans. This doesn't leave very much scope for Indian corporates to borrow and produce goods at a price which are globally competitive. So, deregulation, if it goes on to the fact that assets become better, the government PSU becomes better, as I'm saying again, I'm sorry, repeating myself, convenience of business is not a thing of the budget. It's a thing of day-to-day governance of people down the line. That will not come from the budget. What budget can give you direction is to say how in the fiscal space can the interest rates be controlled, how in the fiscal space government borrowing doesn't take you out of the private sector borrowing, doesn't come out of it. I think that's more important. And PSU banks and PSU companies deregulation, I think that should be more critical than anything else. Rest all is cosmetic because we have good laws. By and large, laws are good. The problem is implementation. The GST guy on the floor, the Factories Act guy, inspector on the floor, he is the impediment, and the labor inspector who comes to your factory, they are the impediments. It's not that the law is bad, it's the implementation is bad. So I'm not sure whether law is required so much as well as the fact that implement it. And for God's sake, please, interest costs have to come down. We can't, if state government borrows at 7.7, what do you expect the corporates to do?
Yeah, absolutely. So from that perspective and that last point, Ajay, is that going to be one key concern that even foreign institutions are going to be asking about, which is the health of the state balance sheets? At the center, of course, fiscal discipline, fiscal prudence is in evidence for several years now. But if you put the two together, is there a question mark?
Of course, there's a question mark. And I'm really questioning whether even the central one is very clear, because I don't know if many people realize that the way our central budget is accounted for, capital inflow is taken as a receipt at the end of the day, which is not what our companies account for at the end of the day. So even in the center, why is it that our 10-year yield is stubbornly at 6.6%, even after 125 basis point RBI rate reduction? The reason is we're borrowing much more than the people can provide you money with it. And you've seen the stress in the banking sector. RBI can keep playing back and forth. And you saw the price it paid. RBI has paid the price by rupee being at 92 rupees, 90, 93 rupees now, literally, if you take a forward cover in it. So, there is a cost to everything. The biggest cost is rupee depreciation. You can play with interest rates and you'll have a rupee depreciation cost. 15% in euros and pounds and 5-7% in dollars. That's a hell of a lot of cost to pay. So, so I take a little different opinion to say center has got its act together. No, it doesn't have its act together. Otherwise, yield would not have been 6.6 for 10-year bond. So it is a major issue. All the institutions are looking at it. Globally, institutions are looking at it. And, you kind of wonder why 270,000 crore went out of this country last year. It's apparent at that point of time. Our valuations, people have been shoved into mutual fund because the interest rates are so low. People don't want to put money in FD anymore or saving bank account. They go and put money in mutual fund who are irresponsibly buying shares at a valuation which doesn't make sense. We don't have a choice. We invest in India, or partly so. The others have a choice. So they took 270,000 crore out of this country. So pain is lower interest cost at the retail level, high interest cost at the corporate level is something which is bothering the system. And that's why what you see very clearly is mutual fund flush with money, buying at a stupid valuation. Therefore, you don't get returns in mutual fund. And our interest costs are high. So I think somewhere down the line, retail interest costs need to go up. People can make money for investment. Government cost has to go down. They need to borrow less. As simple as that.
Ajay, we will have lost an opportunity if we don't ask you what do you think should be bought right now. What do you think is looking interesting as we've started off 2026? We've seen some updates coming in, business updates coming in, and it's difficult to really make a decision right now or come to a conclusion. But what are your initial readings?
No, initial reading is very simple, Tamanna. You don't change the model very much. Your autos are doing well. GST cut has made the huge difference, and the autos continue to perform quite well in the market. There's no need to worry about it. Thanks to the spiral in gold prices, gold loan companies will do extremely well in this year also. It's the best and the cheapest way to borrow money in the market is to pledge your gold, take your money for your business at the end of the day, and it's a secured for the rent. So gold loan companies will do very well. Autos have a very clear path to it. The duopolies are very clear path to it. Whether it is stock exchanges or whether it is telecom, the duopolies will do very well because there is no competition out there. Metal mining, we already seen the resurgence of it because you can't create metals and mines overnight at the end of the day. I can set up a scooter factory overnight, but I can't set up a bauxite mine overnight. So you've seen metal mining theme. And the last what we're really investing is engineering and healthcare. Hospitals can't be taken overnight. Valuations are a problem in hospital sector, but eventually they'll catch up with you in terms of giving you returns. So hospital sector is absolutely fine at the end of the day. Engineering is doing well because exports are doing well. We have gone up the value chain. So those companies are doing well. So few sectors which make a lot of sense to everybody. What you don't want to buy is things like retail, etc. You already saw the massacre in the last week. More is to come. This year, anything with a P of greater than 50, Tamanna, if you ask me, is up for skimming at the end of the day. Anything above 50, which is not growing at that path, I think we'll see a derating in the current year. People are sitting on absurd valuation of shares. Look at the retail companies, 70p, 90p. Are you seriously talking that you're going to make a return out of 70p shares in an environment like this? It's serious. So I think it's not about just what buying, it's also what you should not be buying at the end of the day.
I think that's an important lesson there. Ajay, thank you so much. Always a pleasure speaking with you here on NDTV Profit.